Have you ever wondered how many rental properties it takes to retire? Is it 5 properties, maybe 10, maybe 20, I don't know, 100? The answer might surprise you because retirement through real estate has very little to do with the number of properties you own and everything to do with the amount of cash flow those properties are producing every month, isn't it? Today, I want to talk to my investor friends who are in their 40s and 50s, just like me. Soon, we all will be touching 65 and retiring. And so, friends of my age, having a clear understanding of how many properties it will take to retire comfortably is super important. And yes, even I am not there today. But it's okay because I'm constantly putting in the work behind the scenes. We have to switch gears and cannot keep doing the same things that we have been doing forever if we want to retire comfortably with a bunch of rentals. So, what is the solution? Well, today I'm going to break down exactly how to calculate your retirement number, how many rental properties the average investor needs, and the biggest mistakes that people make when planning their real estate retirement strategy. By the end of this video, you will have a clear roadmap for determining how many rental properties you need to retire comfortably. Let's get started. Hey everyone, if you don't know me or are new to my channel, my name is Vikram Chopra. I was an investment banker turned broker in the Greater Charlotte metropolitan area where I live. I invest and assist other investors reach their financial goals through real estate investing. Let's talk about the dream. First, you need to answer this question. What will you do in your retirement? Do you want to ride a camel caravan through the Sahara Desert? Do you want to hike up the Alps? Check out ancient civilization? Do you want to wake up in the rainforest every morning? Do you want to spend time off the grid in Africa? Visit glaciers that were formed during the Ice Age? What do you want to do? What are your desires? What drives you, my friend? It is very important to answer these questions. You know why? Because the road ahead is challenging. In those tough moments, only these answers will be your inspiration and support. The biggest myth in real estate investing. One of the most common misconceptions in real estate investing is that wealthy investors own hundreds of properties. While some do, many successful investors retire with far fewer properties than people imagine. But why? Because retirement is not based on the number of units that you own. It is based on cash flow. And lesser units, fewer headaches. Who wants more headaches? Not me. Imagine investor A owns 50 rental properties that generates $100 each month in cash flow. That's $5,000 per month. Investor B owns 10 rental properties that generate $500 per month in cash flow. That is also $5,000 per month. Who is better off? Arguably investor B. They have fewer roofs, fewer tenants, less maintenance and less management while earning the same amount of income. The lesson is simple. Don't focus on the property count. Focus on the monthly cash flow. Step 1. Determine your retirement income goal. Before you can calculate how many rental properties you need to know how much income you want in retirement. Again, going back to your dreams, you obviously want to travel and see this great and amazing place we call Earth. Traveling costs money, so take that into account. Let's say your current expenses look like this. Mortgage or housing cost, $2,000. Utilities, $400. Food, $1,000. Transportation, $600. Healthcare, $800. Entertainment and travel, $1,200. Miscellaneous expenses, $1,000. That totals approximately $7,000 per month. Most people want a little extra cushion, so let's round that up with $8,000 monthly. Now, if you have bigger dreams like I do, then add another number here. Don't shrink your dreams, make them bigger. And everyone will have a different number. To make maths easy, let's assume it's $8,000 per month. That means your rental needs to produce $8,000 per month or $96,000 per year after all the expenses. This is your retirement target. Everything starts with this number. By the way, if you're a beginner or an investor and are looking for guidance on how to get started in real estate investing, feel free to book a 20-minute phone call with me. Link below in the description. We can go over the numbers together and come up with an actionable plan. Step 2. Understanding the true cash flow. Many new investors make a dangerous mistake. They assume rent equals profit. Nothing could be further from the truth. Suppose a property rents for $2,000 per month. Sounds great, right? But now subtract mortgage payment, subtract property taxes, subtract insurance, subtract maintenance, subtract vacancy, subtract property management, HOA fees, capital expenditures. Suddenly, that $2,000 rental only produces $300 or maybe $500 a month in actual cash flow. Retirement planning should always be based on net cash flow, not gross rent. The cash flow number is what matters. Let's look at another example. Let's assume each rental property generates $300 net per month. Your retirement target is $8,000 monthly. $8,000 divided by 300 equals approximately 27 properties. In this example, you need at least 27 rental properties. Now, let's improve the property quality. Suppose each rental generates $500 monthly, not $300 that we had before. $8,000 divided by 500 equals 16 properties. Suddenly, your portfolio becomes much smaller. Now imagine each property generating $1,000 monthly, right? 8,000 divided by 1,000 equals only 8 properties. Same retirement income, completely different portfolio size. That's my personal goal. In my mind, I will start getting some peace when each of my properties gives me $1,000 every month. And the personal goal is $20,000 monthly net. Once I get there, I will cut me a retirement cake. I'm not going to wait for my wife to get that cake. I'll walk into Whole Foods, buy me a strawberry shortcake, ask the lady to write Vikram is free on it, and then come home, cut the damn thing and eat it. And you know what I'll do next? I'll start thinking of turning my dreams into reality. This is why smart investors focus on quality deals rather than accumulating doors. I made a video on how to find great deals. You can check it out here. Step 3. Consider inflation. Well, here's something many investors overlook. The cost of living rises over time. What cost $8,000 per month today may cost $12,000 or $15,000 every month 20 years from now. Inflation affects food, utilities, insurance, healthcare, property taxes, maintenance cost, everything becomes more expensive. The good news is that rental income generally increases too. Historically, rents tend to increase over time. A property generating $400 monthly cash flow today may produce $800 or even more over the years down the road. This is one of the biggest advantages in real estate has over many other investments. That is why I invest in stocks too, but my main bread and butter for retirement is real estate. Remember that rental income often grows alongside inflation. That is why if you're planning to invest money in real estate, go ahead and book that free 20-minute call with me. We can look at your deal together. Step 4, factor in mortgage payoff. Well, this is where things get very exciting. Many investors purchase properties using financing, including me. It's called leverage, right? At first, the cash flow may be moderate, but eventually the mortgages get paid off. Let's look at another example. A rental property produces $400 per month after all the expenses while the mortgage exists. Right? Once the mortgage is eliminated, the same property may generate $1,200 every month. That's a massive increase. Many investors discover they need fewer properties than expected. Why? Because they plan to retire after mortgages are paid down or paid off completely. 10 rentals generating $400 each month equals $4,000 monthly. The same rentals might generate $12,000 monthly once the loans disappear. Time can dramatically improve retirement cash flow. That's why don't wait. Start as soon as you can. I have a video of the best rental properties that you can buy in Charlotte. Go watch that. The power of appreciation. Cash flow isn't the only wealth building tool that you have. Real estate investors also benefit from appreciation. Imagine buying a property for $250,000. 20 years later, it is worth $500,000. You have gained significant equity. Some retirees choose to sell a portion of their portfolio and reinvest into higher performing properties. Others use a 1031 exchange to upgrade into larger assets. Still, others refinance and pull out equity while keeping the ownership. The combination of cash flow and appreciation creates tremendous flexibility. You do not have that flexibility in stocks or ETFs or index funds or anything. Let's look at a different retirement scenario. Let's examine 3 common retirement goals. Scenario 1, lean retirement. Monthly income goal, $5,000. Not much. Average cash flow per property, $500. How many properties do you need? 10. This retirement strategy works well for investors with modest expenses, but think of your big dreams. You do not want a modest retirement. I definitely don't. Scenario 2, comfortable retirement. Monthly income goal, $10,000. Average cash flow per property, $500. How many properties would you need? 20. Many investors aim for this level. It provides a comfortable lifestyle while maintaining a margin of safety. Scenario 3, financial freedom. That's where I am. Monthly income goal, $20,000. Average cash flow per property, $800. Properties needed, 25. This level supports significant travel, luxury spending, and flexibility. That's what I want. That is what everyone should want. Hey, if you can buy one property, manage it, put a tenant in it, then it's simple. It just rinse and repeat 25 times. Notice something interesting? The number of properties isn't dramatically different because stronger cash flowing properties can make up for a smaller portfolio. Single family housing versus multifamily housing. Many investors ask whether they should buy a single family home or a multifamily property. The answer depends on your goals. Single family homes often have a larger buyer pool, experience strong appreciation, attract a long-term tenant in it, requires less intensive management. Multifamily properties often produce stronger cash flow, offer economics of scale, allow faster portfolio growth, and provide multiple income streams under one roof. For retirement purposes, many investors eventually transition towards larger multifamily properties because then they can generate substantial income with fewer assets. For example, 10 single-family homes may generate in the same income as one 20-unit apartment building. Less driving around town, less scattered management, greater efficiency. The 4% rule. Alternative traditional retirement planning often uses the 4% rule. So, if you need $80,000 annually, you might need to invest $2 million in the stock market. Investing $2 million is a lot of money. Trust me on that. Real estate offers an alternative approach. Instead of withdrawing principal, rental properties generate income directly. The asset continues producing cash flow while often appreciating over time. This is why many investors prefer real estate as their retirement vehicle. Their money keeps working without necessarily selling the underlying asset. So, if you need some guidance, go ahead and book that free 20-minute call with me. Link in the description below. Why most investors never reach their retirement? Let's talk about the obstacles. Most investors don't fail because real estate doesn't work. They fail because they quit too soon. Yes, I have friends who have known me for years. Every time they talk to me, they'll ask or say something along the line that they want to get into real estate investing. Years have gone by, nothing has happened so far. Many people buy one rental property, then they stop. Others buy 2 or 3 properties and become discouraged by the maintenance issues. The investors who succeed understand that real estate is a long-term game. I work with a colleague. He bought a second home and moved into it. He rented his first house for 1 year and then sold it. I asked why. Oh, Vikram, I couldn't manage it. The tenant had too many problems. He sold his house for $400,000 and the same house is now $800,000. He lost on the monthly cash flow and the appreciation of the house. So not cool. How difficult could it be to manage a tenant? If it's so difficult, get a management company till you learn the ropes. Don't never give up on your dreams. Never, ever. The first property is often the hardest. The second gets a little easier. easier. Then the third becomes much easier. Momentum matters. Small, consistent actions compound over time. The Millionaire Landlord formula. Let's look at a practical example. Suppose you purchase one rental property every year. That is one every year. Not difficult at all. Each property produces $500 monthly cash flow. After 10 years, you had 10 properties producing $5,000 monthly cash flow. That is $60,000 annual income. After 20 years, you'll have 20 properties, $10,000 in monthly cash flow, and a total of $120,000 in annual income, plus appreciation, plus mortgage pay down, plus tax benefits. So, if you are 45 or younger, this is your plan. This is how many ordinary people build extraordinary wealth. Not through lottery tickets, not through speculation, no, through consistent acquisition of quality rental properties. Don't forget reserves. Retirement planning requires margin of error. Properties occasionally experience vacancies, major repairs, economic downturn, unexpected expenses. That is why smart investors don't retire the moment their portfolio reaches their exact target. If your expenses are $8,000 monthly, you may want rentals producing $10,000 or even $12,000 monthly. That extra cash flow provides security and peace of mind. That's why if you have questions, doubts or concerns, go ahead and book that free 20-minute call with me. A better question to ask. Instead of asking, how many rental properties do I need to retire? Ask, how much passive income do I need to retire? That simple shift changes everything. Some investors retire with 5 properties. Other need 50. The difference is cash flow, debt structure, market selection, and lifestyle goals. There is no magic number. There is only your number. Final thoughts. So, how many rental properties do you need to retire? The answer depends on 3 key factors: your desired retirement income, the average cash flow per property, and whether your mortgages are paid off. For many investors, the answer falls somewhere between 10 and 30 rental properties. For others, it may be fewer. Is it worth going through all of this? Absolutely yes. The most important thing is to stop focusing on property count and start focusing on cash flow. Build a portfolio that consistently generates income. Choose properties that produce strong returns. Manage risk carefully. Allow time, appreciation, rent growth, and mortgage pay down to work in your favor. Real estate retirement isn't about owning the most properties. It is about creating enough income to live life on your terms. If you found value in this video, hit the like button, subscribe to the channel, and leave a comment below telling me how many rental properties you think you need to retire. Thanks for watching, and I'll see you in the next video. So until next time, this is Vikram signing off. Good luck, goodbye, and go earn your freedom.